Come on, one more. Let's go, one more. Come on, you got more in you. Come on. There you go. Let's go. Yes, sir.
You hit me. You got me right with those antibiotic steroids.
Yes, sir. I got you, bro. Yeah.
Still something doesn't feel right, bro. Like, I don't know. The meds just didn't feel good there.
Yeah, I mean, after analyzing, there's just something fundamentally wrong with your form. You know what I mean? Like, you just got to fix your fundamentals on the form.
Would you do some sort of fundamental analysis or something? Like, this kid, bro.
I did.
Favorite industries. Now, for the purpose of diversification, you don't want to put all of your portfolio in a few sectors. However, there are some sectors that are favored by growth investors just because of how innovative they are and how unlikely they are to slow down in the near future. Some of these sectors include information technology, healthcare, and consumer discretionary. And the reason these are such good growth sectors is because they're always innovative and coming up with new advancements, such as information technology with AI, healthcare with a bunch of new medical research and new healthcare technology, and consumer discretionary with a lot of new e-commerce platforms and just a bunch of new goods rising. So before we dive into the fundamental analysis and financial statements, I suggest you go back to our video on fundamental analysis for value investing, because that's where we cover a lot of these financial statements in a lot more detail than we will in this series. So first of all, for growth investing, we're looking for rapid revenue, earnings, and cash flow growth, which just tell us how well the company is able to grow. And then after that, we're looking at the scalability of the company, which is essentially how good the company is at increasing its operations and its profits faster than it increases its costs. And lastly, we're looking for reinvestment into the business, which will fund future growth, and ideally the company reinvests its profits rather than taking on excessive debt to invest into the business.
Statement 1, balance sheet. So the main importance of the balance sheet is that it shows us whether or not a company is capable of maintaining their growth and will not collapse due to economic downturns or unpaid debts. Now, there are three things that are very important when looking at the balance sheet, one being liquidity and solvency. Liquidity is the company's ability to pay off short-term obligations, while the solvency is the company's ability to pay off long-term obligations. And then we have high intangible assets, which are things like patents or any other innovation that the company is active in, and this will just help it grow in the future, which is good for growth investing. And finally, we have increasing shareholder equity, and this is just what it shows us whether or not the company is reinvesting money back into the company rather than paying investors with things like dividends. So there are three important ratios to calculate from the balance sheet, being the current ratio, assets to debt, and debt to equity. The current ratio is your current assets over your current liabilities, and this tells us the liquidity of the company. And the average is around 1 or above 1, and you want to be looking for a number above 1.5. Next is assets to debt, which is your total assets over your total liabilities, which tells us the solvency of a company. And like the current ratio, you average is above 1, and you want it to be above 1.5. Now, this one is slightly different than the value investing video. As we said in that one, it should be above 1.8. However, it is okay for a growth company to take out more debt to fund their rapid growth. And finally, we have debt to equity, which is your total liabilities over your total shareholder equity. And this tells us how reliant a company is on debt compared to funding from shareholders. And average is around 1 to 2, and a good one is below 1.
Statement 2, income statement. The importance of the income statement for growth stocks is it tells us the profitability and the scalability of the company, as well as the company's financial performance over the recent years. And there are a few important things we're looking for. We're looking for high revenue and earnings growth, which just tells us the growth rate of the company. We're looking for high scalability or increasing profitability, which in other terms means that the company is increasing its revenues faster than it increases its costs. And lastly, we're looking for high investment into research and development, which will contribute heavily to future growth. So now, there are some important growth rates that we should calculate. For some context, these are all compound annual growth rates, which essentially tell us the average annual growth rate of whatever variable we're looking at over the course of n years. So first we have our compound annual growth rate of revenue, which is final revenue over initial revenue to the power of 1 over n years minus 1. And this just tells us the revenue growth rate of the company, and this should ideally be at least 15%, but preferably greater than 20%. Next, we have the compound annual growth rate of net profit margin, and this is final net profit margin divided by initial net profit margin to the power of 1 over n minus 1. And this number should ideally just be positive, because it shows us the scalability of the company and how the company is able to increase its revenues at a faster rate than it increases its expenses. And lastly, we have the compound annual growth rate of earnings per share. And this is calculated by final EPS divided by initial EPS to the power of 1 over n minus 1. And this should ideally be greater than 15%, but preferably greater than 20%. Now, there are also some important ratios that you should calculate from the income statement. One of them is the net profit margin, which is net income divided by total revenue, and this tells us the profitability of the company, or how much money the company keeps out of its total revenue. And this should at least be greater than 10%, but ideally be greater than 20%. Next, we have research and development spending divided by total revenue, and this tells us how much of the company's revenue is being put back into the business in terms of research and development, which contributes to innovation, which will then contribute to future growth of the company. And this should at least be greater than 10%, which makes it a good candidate for a growth stock.
Statement 3.
Cash flow statement. The importance of the cash flow statement for growth companies is it tells us the reliability of the company's income statement, and it also tells us the efficiency of the company at producing cash. First of all, we're looking for a positive and growing cash flow from operations. This tells us that the company's core business model is actually profitable, and also we want the company's cash flow from operations ideally to be growing at a faster rate than the company's net income, which tells us that the company's quality of earnings is improving. Alongside that, we also want a positive and growing free cash flow. And just so you know, free cash flow is cash flow from operations minus capital expenditures. And this tells us that the company has a lot of financial flexibility to reinvest back into the business or to pay off debts. And it also tells us that the company is very scalable because the company's cash flow from operations is growing at a faster rate than the capital expenditures.
Next is we want usually negative cash flow from investments, and we want this to usually be negative as it shows that the company is purchasing assets like buildings, land, equipment, or anything in general that will help the company grow in the future. And we also want consistently positive end cash flow. Now, it's okay for this to be negative sometimes. However, we want it to be consistently positive, as if it was consistently negative. It just shows that the company is losing money year after year, and obviously that's not good and is not sustainable for growth of the company. So here are some important ratios and metrics to calculate from the cash flow statement. First, we have compound annual growth rate of free cash flow, which is final free cash flow over initial free cash flow to the 1 over the n power minus 1, and generally wants it to be above 10%. And this shows us the scalability and financial flexibility of the company, which are two important factors in growth investing, or growth in general. And next is free cash flow yield, which is free cash flow over market cap. And the S&P 500 average for this is 1.6%. However, for growth investing, we want it to be between 5 and 20%. And this shows us how much cash a company is making relative to its size. And finally, we have the quality of earnings, which is your operating cash flow over net income. And we want this to be greater than 1. And this kind of shows us maybe that if there's any manipulations in the income statement that may have made earnings seem better than they actually were, we can catch that. And it also shows us how much of a company's earnings can be used as cash to put back into the company.
Now, another important metric to calculate for growth companies that is separate from the financial statements is the sustainable growth rate. And the SGR is calculated by return on equity times the retention ratio. And how to calculate these are the return on equity is the net income divided by the total shareholder equity. The retention ratio is 1 minus the dividend payout ratio, and the dividend payout ratio is total dividends paid divided by net income. Now, ideally you want your sustainable growth rate for a growth company to be greater than 10%, but it should preferably be even greater than 20%. And a few things to note with the sustainable growth rate is that in cases of unusual gains and losses within a year for a company, which happen very often, you should replace the net income with a normalized net income, which accounts for those random gains or losses. Along with this, if you see a number greater than 30%, know that it's not a bad thing, but it is an inaccurate number that a company can't really maintain in reality. That's because companies have a sales saturation point at which they won't be able to sell the same product at the same rate, and in order to maintain this really high growth rate, they'll have to branch out to other products with a lower profit margin, placing more financial stress on the company than necessary. So, all in all, note that a number greater than 30% is a good thing, but it's not necessarily accurate. So in this video, we covered 5 major topics about growth investing. First of all, we looked at some favorite industries by growth investors, which are known for being very innovative and rapidly growing.
Next, we went over the balance sheet, which shows us how capable a company is at maintaining its growth.
Next, we looked at the income statement, which tells us the profitability, the scalability of the company, as well as the company's financial performance over the recent years.
Then we went over the cash flow statement, which allows us to determine how accurate the income statement is and how efficient a company is at making cash.
And lastly, we looked at the sustainable growth rate, which tells us the maximum net profit growth rate a company can maintain without financing with more shareholder equity or debt.